The United States is producing more crude oil than at any point in its history, driven by continued growth in shale production. But producing more oil is only part of the equation. Moving those barrels to international buyers requires sufficient pipelines, storage, export terminals, and shipping capacity. And as production continues to climb, that infrastructure is coming under increasing pressure. The result is a growing disconnect between record domestic production and the ability to export it efficiently, raising questions about U.S. competitiveness, pricing, and ultimately profitability. To help us unpack what's happening and what it means for producers, traders, and the wider energy market, I'm joined by Alex Hodes, Director of Energy Market Strategy at StoneX. Alex, good to see you again. So the U.S. continues to produce record volumes of crude oil. Why isn't that automatically translating into higher exports?
So the U.S. has to essentially produce those barrels and then transport them to the Gulf Coast and then to the broader global economy. From that point, it has to transit through pipelines, and then there needs to be storage facilities on site, loading facilities, export terminals that are capable of taking those barrels. In addition to that, you need the tankers that are available at the point of where you are exporting those. So there's a lot of those kind of logistical challenges and constraints that are in place that need to be operating efficiently. And then you need to have buyers that are willing to purchase that crude oil. It's got to be priced accordingly to the global market. So you are seeing right now exports are down slightly from what their record highs were in April and May. So in April and May, the U.S. was exporting around 5.6 million barrels per day of crude oil. Now we're around 3.4 million barrels per day. So although we still have the same infrastructure available, it's really whether there's buyers that are stepping up to the plate and buying that crude oil.
Okay, let's get into the nitty-gritty of things. Where are the biggest pressure points in its export system, and how close are we to capacity?
So there have been in the oil play itself in the Permian Basin, there have been some pipeline constraints there in the past, and we have seen during the Strait of Hormuz crisis, we've started to see some of the constraints kind of poking their head, one of which is natural gas takeaway capacity. So when drillers are drilling for crude oil, they produce a lot of excess natural gas, and they need to essentially take this natural gas away to either be processed or converted into LNG. And essentially in those wells themselves, the natural gas pricing you're seeing in the Permian has hit negative levels. So essentially people are paying people to take it off their hands. So that's one point of constraint that you're seeing. And you saw it several years back before they added additional takeaway capacity, natural gas takeaway capacity in the Permian Basin. And so now you're kind of seeing that running into that constraint as well. The constraints in the Gulf Coast itself, really, we have not even hit our export capacity of crude oil. So at that 5.6 million barrels per day level, essentially the U.S. has excess capacity than that, up to 1 million to 2 million barrels on top of that. However, we really haven't seen our crude oil exports hit that level. So the question is whether we're actually close to that capacity or not. And the analysis says that we still have much more room there. And right now we're at that 3 million barrel per day level. So there's quite a bit of excess capacity. 2 million barrels per day is probably more reasonable of that capacity. However, if the price is there, people are going to try and get the crude oil barrels out as quickly and efficiently as possible. And you need to have kind of that tanker space as well. The tankers need to be in the Gulf Coast ready to transport that product.
Yeah. So if export infrastructure can't keep pace, which doesn't seem to be the problem almost with production, what does that mean for the U.S.'s position in the global oil market, if that were the case?
So I think where we're going to see issues here is the U.S. continues to draw down on its SPR, and then exports those barrels to the broader economy, to the global economy. And when you're going to see the issues is if the SPR starts to hit its level where the U.S. is not supposed to essentially draw down past a level.
Right.
That's when you're going to see those crude oil exports start to slow down coming from the SPR. And the U.S. will have to price up its crude oil to essentially compete with the global economy and keep those barrels at home. So really, the U.S. is going to continue exporting until they can't, or until the pricing tells them to keep those barrels at home. We're not at that level right now.
Yeah.
That temporary MOU signing did provide a little bit of cushion. Some buyers are kind of still on the sidelines, not stepping back up to the plate. We're not seeing the huge export numbers, but in the most recent DOE report, we did start to see an uptick in diesel exports, crude oil exports, propane exports, which kind of tells you that the U.S. is back to full on trying to export as much product as possible as they are retaining those profitable margins there.
So this isn't just about moving more oil then, it's more about making the most money from it. So how do these export bottlenecks you just described affect prices and producer profitability?
So you see some disconnects here. Occasionally you'll see kind of the export terminaling fees go up when there's a large surge in demand. And that's going to be kind of reflective of how many buyers are kind of stepping up to the plate, how many people are how much you're trying to kind of push out those barrels. And we've seen one big part is the diesel Gulf Coast pricing. So there's a Gulf Coast pipeline price, and then there's a Gulf Coast waterborne price. And you're seeing the waterborne price at near record premiums to the Gulf Coast pipeline price. So that tells you that there are these increase in demand of barrels, and these logistics are really going to be pushed to the brink. And that's going to be one of those factors that you need to keep an eye on, because if there's any issues with tropical storms that could affect these, if stuff is running at capacity, you're going to start to see some of these markers kind of hit these levels where it just is unprecedented. If you see Gulf Coast waterborne prices substantially higher than Gulf Coast pipeline prices, that's going to tell you that that demand is kind of full bore. It's and that's kind of what you're seeing right now. So it tells you a lot more about the status of what the infrastructure is at and whether it's kind of being pushed to the brink.
So in your opinion then, who benefits from these bottlenecks and who loses out? Who are the winners and who are the losers?
So I think the biggest winners in this situation are those with the export capacity, those that own the terminals themselves, those that are refiners that are getting a better price abroad than they are domestically. Anybody that's touching the global economy and has access to waterborne prices, those are going to be the winners of the economy. Really, in addition to that, though, you're also seeing the producers are hitting levels that they hadn't seen in several years. So, however, those were the U.S. producers have been a little bit hesitant to kind of ramp up their production because there's so much instability in the market, and they don't know if these prices are essentially here to stay. So the ones that are really benefiting are the ones that are kind of the midstream players, the ones that are touching export capacity, and those are the big winners here.
Understood. Alex, thank you as always for all your insight and for joining us. And thank you to our viewers for watching. For more financial content, don't forget to like and subscribe to our channel. We'll see you soon.